Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful, active, passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint. All right, welcome back to the podcast. Have Tom Stein, Director of Investor Relations for Breneman Capital, joining us again today. Hey, Tom.
Hey, Drew. Thanks for having me back on the pod. We're going to talk through some misconceptions today and some other commonly asked questions from investors.
Yeah, so that's the game plan. We just already did that episode about this commonly asked questions from investors, and then we wanted to run through common misconceptions here. I think so. We have this list ahead of time almost that we're going to pull from like a Q&A type thing. But then I think, I'll just start it off. I mean, I think one of the most common misconceptions is around depreciation and just how the taxes work in general on these deals. Like I've heard people pitch investment offerings and they're going, oh, year one, you'll have a tax loss. So that means you'll never pay any tax. Year two, same thing. And then that is not how it works, what I just said. And then also, by the way, we're not CPAs. So, I'm sure my attorney would be thrilled to hear we're just doing like a tax podcast to start. But so definitely
throw the disclaimer out there. Yeah. I'm not a CPA either.
Listen to the full disclaimer at the end of the episode. But also, we're not CPA. So everything here you want to use just for like informational purposes, like, hey, maybe I should ask my CPA or my attorney about this. And because everyone's situation too is a little bit different. So then that's where kind of these misconceptions come up where like one person can use like tax losses a certain way means someone else doesn't necessarily mean everyone can, or just because this person in my example said there's no taxes in year one ever. Maybe that was true on his deal, but that's not how it works on most deals. So anyways, I think a big misconception is around depreciation. And so how depreciation works is you're able to write off the building improvement value of the property over a certain number of years. In commercial property, it's 39 years. Residential, it's 27 and a half or 30 years, depending on what kind of accounting you're doing and whether you're elected for this election that's this 163J stuff. And so if you, in all of our deals right now, since that I know that I've personally been a part of since 2015, all of them are allocating tax losses right now. And so I know like year to year, my investors and myself, we're not paying any tax on the cash distributions we're receiving on those deals. But I did never say it as, so we never pay any tax ever, because what'll happen is, so you take this depreciation deduction, and then because of that, that's wiping out your income. So you have, so go through like a made up example here. Let's say you have $100 of rent coming in, your expenses are $50, your interest expense is another $25. So you have $100 coming in, $75 of like actual real expenses that are, you're writing a check for, you have $25 of cash left. So you then distribute out $25 to the investors. But let's say your depreciation deduction, which is a non-cash expense, you're deducting your building improvement value off over that lifespan. Let's pretend in this example, it's $35. So now I have negative $10 of taxable income. Maybe hopefully we can still follow this, but 100 minus 75 minus 35, is negative 10. So now we have a loss of $10, even though we paid out 25. And so what happens is you don't pay any tax yet on that money, but when you go and sell, you have to pay depreciation recapture tax. And that's 25% federal plus the state tax rate. And then that's going to be the state that the property's in or the state that you live in, whatever's higher. If you live in a higher tax state, then you get credit for the tax you paid in the lower tax state. So let's say you live in California, you invested in one of our deals in Wisconsin, you pay the Wisconsin tax on the depreciation recapture, then you pay whatever is above that percentage to California then. And so then you eventually do pay tax. But one of the reasons we like long-term investing is to delay paying that depreciation recapture tax. So let's say, your typical deal, like most syndicators are doing, they're owning it for 3 or 4 years. So let's say you take a loss for tax purposes year one, but then you just sell it 2 years later. That's not that big of a timing benefit because you have to pay depreciation recapture when you sell. So then for us, we like doing, 7 to 10 year holds. And then it's because you have a much better, I like much better timing benefit. I have deals that I bought in 2010 where, still cumulatively we have like a tax loss and I haven't paid any tax, personally on that income, and we've distributed every year for 15 years now running. And I haven't paid anything yet, but I don't say I never will. Eventually I will owe tax. I mean, you can also further delay this payment by doing a 1031 exchange. And then I guess it is possible to fully avoid it. If someone was able to continue to do 1031s or hold the property until they pass away, then sure, when you pass away, you get a step up in basis, which then, now let's say if the property, your basis was $30, now it's worth $100. It goes to, for tax purposes, for your heirs, it starts out at 100 is the new basis for them. But then that assumes you don't pay estate tax. So anyways, there's a lot going on in the tax world. So it's never as simple. So then it hurts my ears because I've seen some webinars I've hopped on of people and it's like, there's no tax because of depreciation. And there eventually will be, unless you are, I guess, that person who continue to do 1031s until they pass away and also, have an estate under the estate tax limitation amount. So maybe anything you want to add to that, Tom?
No, I mean, I'm asked oftentimes like, I hear these things and you never pay any taxes on these investments. And that's not the case, at all. I mean, like you have to, like Drew explained, like there are taxes that, that we like to defer as Breneman Capital, like we like to defer them, 7-10 years. But it's a misconception to think that these investments, these real estate investments, you're not going to pay any taxes on them. So definitely pay attention to how depreciation and depreciation recapture will come back and what you're going to be paying ultimately at sale. So
one point I did not hit is, with depreciation. So then if you hear this, you go, so depreciation, maybe it's not that great at all now. You got to eventually pay tax. You have the timing benefit, but also you have a rate benefit. So it depends on your personal situation on what your tax rate would be on passive income. But for most people, it's much higher than the 25% depreciation recapture rate, tax rate. So then you're paying less in tax, and then you're also paying it much later. So again, to go back to my personal example, I received cash in 2010 from that deal. I have not paid any tax on that money yet. And, here we are at the end of 2024, still not having paid anything. So I have 14 years of delay on that. And then plus whenever I do pay, it'll be at a lower rate than what I would have. So there are a lot of benefits, but that's misconception number one is because of depreciation, there's no tax. The next one, preferred returns is something that I think there's a misconception around. And so I'll throw this one to you, Tom, but I think the misconceptions are twofold. Like people think that the preferred returns are guaranteed. And then they also think that the preferred return rate, that's the cash flow rate from the deal. Like how much cash is, so are both of those things correct or incorrect?
No, both incorrect. So basically, your preferred return is essentially how we structure the economics and the waterfall of the deal. So for example, in our LP memo, our offering memorandum per deal, we have what's listed as the preferred return, which is typically 8%. And then we also have like our underwritten cash yield or cash on cash, which is, probably going to be less than 8%. So they're different things. The cash yield and the cash on cash is what the deal is generating, what the property level is generating in terms of cash flow. And that 5%, for example, is what's paid to our investors. However, that 8% preferred return is what we've agreed with them to be paid as possible. I mean, that's 8% preferred return is what's owed to them over time. And usually what we do is cumulative compounding. So in that example, the 8% preferred return is the first tier in the waterfall. However, you're being paid 5%. So hypothetically, if you have a $100,000 investment, you're going to be distributed $5,000. However, that 8% preferred return equates to $8,000. So if there's a gap and we're not able to hit the 8% preferred return, then that $3,000 is then tacked onto the principal, and then you start compounding, and then that your principal balance is then $103,000, and then that starts compounding basically year over year. But essentially, it's not guaranteed. If the deal doesn't perform as well as it should, I mean, that 8% preferred return and compounding is not always guaranteed and not always paid. But that's the first tier in our waterfall. So I would focus on that, because that 5% cash on cash is not equivalent to the preferred return, which is a separate thing.
Yep. And then I think the way I like to, explain it is just, let's say for the not guaranteed part is, let's say the whole deal, in your example, it's an 8% pref. Let's say the whole deal, the deal level returns were 6%. Then that means the investors are going to get the whole 6%, and that there will be no incentive fee paid to us, because we did not exceed the 8% hurdle rate. So, so the preferred return is there not to say this is a guaranteed number or this is your year one cash flow. It's to say you're getting the first X percentage. On ours, it was 8. The first 8% of return is going to you. Then the flip side, it's not the year one cash flow. Actually, one of the deals we bought at the end of last year, I think the cash on cash was 15% this year. So then how that would work is the first 8% went to the investors as their preferred return, and then that was paid up in full, and then that extra cash flow, that's going to be going against their initial capital. So then, if let's say in the $100,000 example, if you have $100,000 in, you have $7,000 of your money already returned back to you in year one that you can go put into a different deal, and then that so it works both ways. If you exceed the preferred return, then you go to the next part of the waterfall. So it doesn't it can work where you exceeded or are below. So
yeah, exactly.
Going down the list, I think another one is, related to tax losses. So it's similar to the depreciation conversation, but a lot of people are really concerned, and real common question is, if we do cost segregation studies, people really want these losses. And then the misconception is, around how many people can actually use them. So maybe Tom, if you want to enlighten us on kind of how it works with who can use it, or, how many people typically are using the losses on other stuff.
Sure. Yeah. So as Drew outlined in the first example here, so essentially, hypothetically and hopefully, you're going to have a year-over-year tax loss carry forward, and that those losses, like say for year one, you have that minus $10 taxable loss. If you're a W-2 employee and you're making, say, $200,000 a year as an accredited investor, you can't really deploy that minus $10,000 loss to your W-2 earnings, because it's a passive loss. So typically how these are allocated is these losses are kind of pooled with your passive investments and then applied against those other investments that are passive. So essentially you can't really use those losses for active earnings, W-2 earnings, 1099s, et cetera. They're allocated and used with your passive investment and passive investment pools. So that's one misconception. And then the second one, the cost segregation. Yeah, I mean, cost segregations help accelerate those depreciation losses to you, say for years 1 through 5. That doesn't necessarily mean you're never going to pay depreciation recapture on that. It just, those losses are accelerated to the front half of the deal, per se, for a 10-year hold. The first 5 years, you're going to have a higher depreciation loss and higher losses. But again, those are typically only applicable to passive investments. If you're a real estate professional, you have kind of a classification within your tax return, and then you could apply then some of the losses you receive via your K-1s to your tax return. However, you have to be a real estate professional, like a broker or a full-time real estate employee.
Actually, not an employee. Just to jump in, it's actually like, I don't think, for example, like, I don't think you would qualify, Tom, with how it works. Yeah. So if it needs to be. It needs to be within like a business of yours, is my understanding. So it's, again, this is why it's important to talk to your CPA, because I don't make this election either. I haven't needed to, because I just have so many losses. Like I don't have other sources of income outside of these deals. But people who, let's say if I was also a broker doing real estate, I could make an election and then start treating all my income as one type, essentially, because I do real estate over a certain, number of hours per year. But if you're an employee somewhere, that doesn't count, even if it's in real estate. And so it really only works if you're like you have your full-time investment or property management business or brokerage business in real estate. So it's very limited on who can use it. We do have some investors that do use that, of course, but most people, they're out there searching for these losses on these deals that then they actually can't even use. So then that's kind of the main point around this with the misconception, not like, let's dig into the 0.1% of people that can use them. It's more just your average person is out there going, how much will I get in losses? And they can't even use it. Of course, if they own some investment properties themselves that are like paid off or something that are generating taxable income because there's no interest expense, sure, then that would be great. You can use the losses from our deal to offset some of the passive income you have on your own deal. We have one of our larger investors does that. They own a bunch of properties they bought 1 million years ago in California, and they love the losses they get from our deals, and they can use them right away against their passive income on their California deals. So like it does, some people can use them, but that's the biggest misconception, is that everyone can, and then they see this loss of whatever $10,000 on their K1, and they think, okay, I'm saving $3,000 in taxes. If I just had to guess, for 90% of the people investing in syndications, they cannot use that loss yet. Now, number 4 misconception, so just kind of going right down our list or whatever number we're on, I think is around 1031 tax deferred exchanges. And so a 1031 tax deferred exchange, for those that don't know, allows real estate investors to sell a property and then buy another property and defer paying any capital gains or depreciation recapture. And you can do multiple 1031s, back to back to back to keep this deferral going on for a long period of time. And so that's a big benefit of investing in real estate. And so a common question is that just all real estate investors, no matter how you are coming into the deal, can do 1031s. And so just to kind of answer some of this, if you're in a syndication, let's say you started out, you invested in one of our deals and you put in 100,000 and you have a 1% share of the deal. Unless some structuring is done, you cannot just do a 1031 out of that syndication interest you have. Because from a tax standpoint, you own a membership interest in an LLC, where to do a 1031, you need to be a direct property owner. So our LLC that we formed that you invested into, that entity could do a 1031. But that would mean every investor would want to be on board with doing a 1031. And so what some people do is they do this, drop and swap arrangement, it's called. So prior to selling, they separate out that one LLC that owns a property and have the property now owned by a TIC, which stands for tenants in common. They'll have now 2 different LLCs own the property. And in each LLC, they basically divvy up the investors based on who wants to do a 1031, who doesn't. And the LLC that now, let's say, is a 50% owner in the deal that has all the people that want to do 1031s. When they sell, that taxpayer goes on and does a 1031. And then the LLC that was the other property owner that doesn't want to do the 1031, they just liquidate upon sale. So that's why, that's a complicated structure and a lot has to be done. So then it's not as simple as to go, oh, I'm in real estate, I'll just keep doing 1031s, unless you're part of a drop and swap, or you're not able to do that. And then similarly, right, if then let's say you like a syndication and you're selling a deal yourself that let's say you own solely, and you want a 1031 into like a syndication of ours, and how would that work, Tom?
Yeah, that's come up a couple of times. It's a small percentage of our investors, but there's been a couple of cases where investors sold a property. He wanted to 1031 into something, couldn't identify within that within the window there, and he liked our syndication. He wanted to invest, but he didn't want to have the tax, the capital tax, the tax gain. So what I proposed was a lazy 1031. So basically, he invested some proceeds from his sold deal into our deal, and then what we're going to do is, we're going to have taxable losses allocated towards him, but we're also going to have perform a cost segregation study to accelerate the depreciation to him and to all of our investors, actually, through years 1 and 5. So essentially what he's done is a lazy 1031, where he will, the same entity that sold that property and is now invested with us, he'll be, allocated a, pretty hefty loss, and essentially to wipe clean or wipe out his capital event from the sale. So that's a lazy 1031. So doesn't typically apply to a lot of our investors, but if you do own, a duplex or, a triplex somewhere and you are selling, you are able to basically do a lazy 1031 into a syndication.
Yeah. And then just to, reiterate how that works. I mean, the main thing is it needs to be done within the same tax year. So then in this example, he sold a property in 2024. Mm-hmm. He decided, to invest in our deal, which closed in 2024. Yeah. And now this is a good example to go back to the people who can use the losses or not, and why you got to talk to your accountant. And there's not just, one just way everything works in a vacuum. Now he's going to be able to take the losses that we're going to allocate to him, that his share of the losses or not, that he gets allocated from that deal in the deal he invested in with us, and then use those losses to offset some or all of his capital gain and depreciation recapture tax. Yeah, so then that's, some people call that a lazy 1031. If you call your accountant and ask for a lazy 1031, they probably won't know what you're talking about. So you have to just, explain it where I can use the losses from the new deal to offset some of the gain on the old one, right? Like that would be how to say it, or send them a link to an article where they explain it. Cause that's definitely not when you're getting your CPA license, a term that you get taught. That's more like a slang thing.
Yeah. They'll see the gain and then they'll see the loss, for that entity for that year. So it's a pretty tax efficient manner to, if you can't identify something yourself to, invest directly, then, syndications are an option.
I just thought of this. It's almost like another kind of way to offset your gains on a sold property. Because this is my personal situation. I have a lot of accumulated losses that I have not used. Mm-hmm. And then we've, in the last 3 years, we've sold, 6 or 7 properties, and some of those we did 1031s on. A lot of them we didn't. And then I did not owe any tax or depreciation recapture personally on those deals, because I had enough already accumulated losses from other deals sitting there. So all the gains from those other deals just ate into my losses, but I still have more losses that I carry forward and keep accumulating them. So, that's another way to do it, I guess, too, is if, let's say you had invested in 5 syndications and you're one of the 90%, as I was saying, that can't use your losses yet. Well, if you sell one of your syndications, potentially all those accumulated losses you can use to offset the gain on the one you sold, and can continue that on for a while, because that's my personal situation, at least.
No, that's well said. Yeah, that's a good marketing point too. I think it's in our company overview of, I think Breneman Capital's paid actual distributions over $40 million. However, on paper and on all of our tax returns aggregated, our taxable income's minus $4 million. So
over that same period. Over the same period. Yeah. I knew it was something like that, but I was surprised when I saw the totals. So
yeah, I was kind of getting surprised when I was summing everything together, and once it hit, it kept going after 20 million, and I was kind of blown away. But yeah, it just kind of drives home the tax efficiencies of these investments for sure.
Yeah, and also some of that 40 million, that's deals that have sold and then we paid out. So then also, like, in aggregate across all of our deals since 2009, we've generated so many losses, tax losses, that we're able to offset the capital gain on a lot of the deals. So then that's a depreciation recapture. So then that's why I was surprised. I thought for sure we'd have some taxable income, because we have deals we sold in there. So
it's minus 4 million. So
those losses add up. But yes, and then I think the other thing around 1031s that a point to make is you can 1031 into a syndication. The thing is, technically you're not 1031 into that same entity that all the investors are. You'd have to, if you remember how I said on the sale process, you'd have to set up a tick, and then the 2 direct owners of the property would sell the property and then go their separate ways, so to speak. This is kind of similar, where you're coming in from separate directions and then both going to be direct owners of the property. So it's possible to do that. But like, I think, you had mentioned like there's a minimum investment that's required just because it's like it's additional complication, and depending on with additional costs and setting it up as well as ongoing just additional work there. And then depending on what percentage interest you'll have in the property, you might need to be underwritten by the lender. So there's just more complications there, but it's possible. Again, that's why it's just not always, just you can just do one thing always. So then that's why it's one of the top misconceptions. I think the last misconception I have on the list here is just that I think most people, they think the best places to invest are just wherever the population is growing. Like you hear, okay, Texas, Florida gets all these corporate relocations. So that has to be the best place to invest. You're getting so much population and job growth. And so people often ask me, like, is that the best place to invest? And I said, I mean, it depends. I mean, that was doing great when the supply of apartments was low and the population growth and job growth was there. It had a really nice run, 2013 to 2022. I mean, most of the Sunbelt states did phenomenally, but when you're looking at population and job growth, you're only looking at half of the equation. Like multifamily real estate, or really all real estate, is supply and demand. And so the supply and demand dynamics are going to change the rental rates. So if you have, like when, let's say Austin, Texas was just booming in 2020, you had a situation where a lot of people were moving there and there wasn't like a flood of new housing being built. So then prices shot up. Now in the Sunbelt, you have the opposite. You had all these developers start projects and you have a record amount of new apartments being built in all of these Sunbelt cities. Somewhere like Austin, that has 15% of the existing inventory in new supply coming online. So let's say if there's 100,000 units in the market, that means there's 15,000 new units being built right now. And so, whereas you then compare that to a place like Chicago, if you use that same math, it's like 1% of the existing inventory or less is under construction. So you're only looking at one side of the equation. And right now, the whole Sunbelt is going through a slowdown in the rate of change of job and population growth, as well as an explosion in new supply of apartments. Yeah. So in a lot of these markets, rents have dropped 10+%. The occupancies in most apartment buildings are in the 80s. Whereas you compare that then with, let's say, the Midwest, and this is why we are, all in on the Midwest. Somewhere like Madison, which is where we bought our most recent deal, it's number 2 in the country for highest occupancy, just after Manhattan. The next city is Madison. And then Chicago, Milwaukee, those cities are all right there. Grand Rapids, Michigan's another great one where they have very high occupancy, and then that makes the rents grow because supply and demand. And so no surprise then, Madison is number 4 for trailing 1-year rent growth in the country. And so then, and also number 6 for leased new supply. In Chicago, for any large city, is number 1 for leased new supply. In Chicago, the city of Chicago right now, there's only 2 buildings over 50 units being built. Normally there's thousands of units under construction, but just a combination of high interest rates, all the developers looking to the Sunbelt, and then also Chicago specifically passed a ordinance where you have to do 20% affordable units on new construction, which then it's already hard enough to get stuff built with how expensive costs got and interest rates going up. Now add in that you can't charge full market rate on a 50-year building, and then the deals are not financially feasible to build. So that's unfortunate, for your average renter, because now there's less supply of new units. Great for us as real estate investors, because that's, now we have more people, looking for at the basically the same amount of units in the marketplace, and then that's going to drive the price up. So, and then another last point that surprises people is let's say in Chicago, in the north side neighborhoods, the downtown neighborhoods, and this is like, I have a link I oftentimes will send after these investor calls we do, because it has the population growth in those neighborhoods from the 2010 census to 2020 census. And those neighborhoods grew at a rate similar to like Denver or Dallas. So overall, Chicago's still, flat, and Illinois is flat to down population wise, but those desirable neighborhoods in Chicago are still gaining. You have, most people that grow up in Wisconsin or Michigan or Iowa, Indiana, they want to be in those parts of Chicago when they're young, and then just kind of stick around. So.
No, well said. I mean, I tell a lot of investors, it's basically simple. It boils down to simple economics, like Econ 101 of supply and demand. And then markets we're targeting, like you've mentioned, it's the fundamentals are so solid, and there's not a lot of new supply being delivered, obviously, but then the population growth, like you mentioned, on the north side and west side of Chicago, these are markets we're targeting for high caliber deals, high quality assets, and great locations. So that's where we're targeting, and it bodes well for future rent growth. And I like to point out too that a lot of our renters throughout the last, I'd say since I started, the transition was basically live in the city for a while and then buy a home. A lot of people can't afford to buy a home right now because of interest rates, so people are continuing to rent because it's so cost prohibitive to buy a home. So supply and demand, the demand is strong, basically.
Yeah, that's a good point. And also people are just. Now it's almost like a cultural thing. People are renting longer. They're having kids later. They're getting married later. And then that just creates more renter households. I mean, people back in, 2006, 2007, they were all excited about buying like a starter condo they could make money from. And that sort of like belief got shattered in 2009 and 10 and 11. And I think young people today don't share in that. They think, they're buying homes for, the very long term, or it's an area that they can't find a rental in, or that they want to be doing customization. They're not talking as much about, building up a nest egg with a home as much. That's not as rarely talked about. I mean, obviously you still can make money on a house, but it's not what it was when like the condo market was just going crazy back then. So, well, great. Well, yeah, let's leave it there, Tom. So then I think if people want to, get in touch with you, get in touch with us, how do people do that?
Yeah, email is great. Email is tstein, that's TSTEIN @Breneman.com, or go to Breneman.com and, navigate towards my Calendly. So that's a direct link to my calendar. And we can schedule a 30-minute time to chat on the phone or Zoom. I'm happy to do either. So love to hear from you.
And then if you want to sign up to be on our investor list, so we send out all of our deals just by email to people that are on our list. Yeah, you just go to Breneman.com and click invest now in the upper right corner, and then put in your name, email, and investor type, and then submit, and you're on the list. So
yeah, it's easy.
All right. Thanks, Tom. Appreciate it. Thanks for coming on.
Yeah, thanks, Drew. Thanks for having me.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, Breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording, and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.